Well, I would argue in many respects we're seeing deflation. People don't notice it because the dollar is inflating, and so prices are getting more expensive in dollar terms. But take an ounce of gold and measure anything that you can in ounces of gold. Go back as far as you want, from 1971 on, go back and measure it in ounces of gold, and you'll find prices are actually going down. The macro picture, we have a debt that's spiraling out of control, north of 38 trillion, $1 trillion increase in about 71 days, which is unsustainable. We have a government that can't agree, again, with partisan politics. Here we are, shut down for an extended period of time, creating greater problems all around the ecosystem, from entitlements and food stamps all the way up to the military. We have a Fed announcement today, I believe, or tomorrow, where they are going to presumably lower rates. Again, their inflation target, as measured by the CPI that comes out of the the BLS, tells us that inflation is at 3%. Now, John Williams of Shadow Stats would say, no, try 11%, add an 8 to that number, because if we just simply measured inflation by the way they used to, we're at about 11%. But even if we believe their BS 3% coming out of the BLS, Bureau of Labor Statistics, that's 50% away, 50% from their target of 2%, which they've missed for, I don't know, almost 60 straight months. They call it tepid inflation, yet it's 50% away from their target. They will come and lower rates again to pour more inflation, or more gasoline rather, on the inflation fire. And we have a labor market, which again is quoted by the BLS, which in many ways is not right. It's much worse than they tell us, and it's already kind of bad and getting worse. I don't mean to sound overly pessimistic, but the fiscal irresponsibility is beginning to catch up with us. And when you are creating, in essence, $1 trillion of debt in less than 2.5, 3 months, and 1 trillion seconds ago was 31,688 years ago. When you look at a market that has rallied to all-time highs based on the performance of 7 stocks, all-time record poor breadth, the worst ever. When you're looking at a system of record low savings and record high indebtedness, and a Federal Reserve that is trapped, and a government that can't even agree on basic things to keep the lights on and keep things running, I am not overly optimistic at this time as to the short-term direction of the economy. And I don't do that to be pessimistic and try and sell precious metals to the crowd based upon fear. That's not it at all. It's just that at some point, these things have to start to have meaning. And that largely is the irresponsibility of our fiscal policy that's just spiraling out of control. And I think it will come home to roost. At the same time, I guess I would like to add one other thing from a contrarian indicator. Since the beginning of the year, we've seen constant outflows by the institutional investors out of the equity market, constant outflows. We've seen guys like Warren Buffett sitting on $500 billion in cash. Jeff Bezos sells $7 billion in Amazon. Zuckerberg selling a bunch. Jamie Dimon selling a bunch. We're seeing the inside money leave at a very fast clip out of the equity market at all-time highs. At the same time, we see the retail public, mom and pa investor, who is at an all-time high in terms of their allocations to the precious metals, to the equity markets, all-time high, like 55%. At the same time, all-time high on margin debt, which is speculation and leverage, and all-time high on option debt or option plays. So you have a public that is all-time in speculating on options, all in the market itself, speculating on options and on leverage with margin debt. over $1 trillion, all-time high on all three, as the smart money is moving the other way. So I think it's you ask yourself what could possibly go wrong. Um, I'm not overly optimistic right now. I wish I were, but I'm not, and I think change has to happen. I think we're in the midst of watching change, maybe even a new monetary system happen right out from underneath us right now.
Stock markets sit at record highs, but the celebration feels hollow. A handful of mega-cap tech companies are pulling the entire market upward while savings plunge and consumer debt hits new extremes. Margin borrowing, leveraged money used for speculation, is now over $1 trillion, meaning many investors don't own their gains. They owe them. Large institutions are quietly exiting, holding huge cash reserves. Billionaires like Buffett, Bezos, and Diamond are reducing exposure. Retail investors, however, are all in. History shows these peaks don't last. When optimism disconnects from economic reality, sharp corrections often follow.
This may be an attempt to debase the dollar, an attempt by the government in every way. Even though they're talking one way, their actions are signaling something different, to debase the dollar. And it's called the debasement trade, the devaluation of the dollar. The reasonings would be easier to pay off the debt. And I believe their idea ultimately is to debase the dollar further than people think possible in order to bring back manufacturing. It's the only thing, the only hope we have at this point right now is to bring back manufacturing. You have right now, normally I'm in my studio and the monitor is much bigger where I can see a couple of the notes that I wrote down, but we're having problems with that. And I can see a golf ball 250 yards away. It's a computer screen 3 feet in front of me, that's a problem. 60% of this country has a reading ability not higher than a sixth grader. 60% of this country has no college education. AI will eviscerate 50% of entry-level jobs in less than 5 years, according to a recent study. We don't make anything anymore. And we have a massive divergence between the people who have money and the people who have none. We're in trouble. Our children are in trouble. Our grandchildren are in big trouble if we don't bring back manufacturing. But Triffin's dilemma, which is a economic theory that says as the world reserve currency, you will always have a problem of a trade imbalance and a loss of manufacturing, because what happens is that you can't give the world enough in the way of dollars as the reserve currency through trade alone. And their needs for everything from, loans to purchasing commodities like oil to just running day to day across the board, there's not enough dollars out there. So they have to sell their currency in the open market. We're continually creating currency, and they are continually buying currency our currency in order to do trade. That lowers the value of theirs and strengthens ours as the demand for more and more dollars to facilitate global trade accelerates. You end up with a strong dollar against weak currencies. Now, that doesn't mean the dollar is strong. It just means it's strong against a basket of crap currencies. But over time, the continuation of doing this makes manufacturing flow towards the countries where it can be produced for a fraction of the cost. And that's why we've had cheap goods forever through, at Walmart, because manufacturing left this country and went to places like China and Vietnam, where it was a fraction of the cost to make that product. And so you will always run a trade imbalance. The former chief economic advisor for the White House administration, or the Biden administration at the White House rather, a true knucklehead in every sense of the word, was Jared Bernstein. If you ever watched him try to explain on X how treasuries were created, it was one of the most humiliating things I've ever seen a politician do, or a person in a high-ranking position such as Jared Bernstein. You should watch it if you haven't. Anyways, he wrote a report called Dethrone King Dollar a few years back, advocating for exactly what I'm saying, that being the reserve currency because of Triffin's dilemma is past the point of benefiting us. For many years, We had low price goods at the store. We had low interest rates because the world would take their excess cash and put it into U.S. Treasuries, dropping interest rates or dropping interest rates and raising bond values. So it was great for us. We had high asset prices, cheap goods, low interest rates. It was great. But now we're past the point of it being a benefit. We're too far down the road in terms of indebtedness, and we're running into a point where the world is changing and we don't produce anything. And if you're not working in California or New York in terms of tech and AI or financial assets, and maybe even Hollywood, which is even moving more towards AI, you're dead in a general sense of the word moving forward. And so I think what they want to do is grossly devalue the dollar. And they'll do that through letting commodities like gold and maybe even Bitcoin go much, much higher to bring back manufacturing. It's the only way. You have Vice President Vance, who has recently said the same thing on White House letterhead. Triffin's dilemma says that the world reserve currency is no longer a good deal for us, more or less is what he said a few months ago. They understand this. And if we want any hope of our children and our grandchildren having a future, let alone national security, we can't rely on China for pharmaceuticals, from aspirin to penicillin. We can't rely on China for all of our military components and aircraft components and everything. We need to do this. And not only that, for 60% of America with less than, a sixth grade reading level and no college education, if we don't, we're dead. And I think this is an issue of national security. So saving in dollars, in my mind, is the worst possible thing you can do. You'll go broke. As Rick Rule, who you had on your show recently, a good friend of mine, says, you save in dollars, you're destined to go broke. You're not a contrarian right now. You're destined to be a victim. And I'll quote him in saying that. It's true. And we're at that point where, there is a way to grow ourselves out of this problem, but it could take a long time. Short of that, as my mentor used to say, the Federal Reserve is boxed in. They have two choices, but to hyperinflate or default. Inflate or die, he used to say. And that's true. There is no other way out when you have a literally $200 trillion debt obligation, 38 that we talk about, but Medicare and Medicaid and Social Security, government military pensions are all unfunded. So if we don't do this, if we don't find a way to do this now, and kind of like the movie The Shawshank Redemption, where Andy Dufresne had to crawl through 2 miles of shit to get to the other side. Well, there is hope on the other side, but you got to crawl through that too, one way or the other. And I think they understand that, and that is to bring back manufacturing. And I think they will do that with the implementation of the Genius Act, which we can talk about if you'd like, which creates synthetic demand for U.S. treasuries and other things. And Judy Shelton's idea of pegging gold to the back end of the treasury market on July 4th, saying Trump told her he would do this, July 4th next year, the 250th anniversary of the country, which would enable you, if done properly, to bring back manufacturing at zero upfront borrowing costs. So I do think, to your point, intuitively, yes, it is bad for the dollar, but there might be more to that than meets the eye, I guess is what I'm trying to say.
A silent shift may be underway, a transition toward a different monetary system. Some policymakers appear to favor devaluing the US dollar, which would make exports cheaper and revive manufacturing, but at the cost of purchasing power. This shift ties into the Triffin dilemma, a long-recognized problem where the world reserve currency eventually undermines its own economy. By keeping the dollar artificially strong for decades, the U.S. exported manufacturing to cheaper regions, leaving workers behind. A weakened dollar could restore jobs, but also erode personal wealth. National security and economic survival may depend on reshaping the system.
Well, I would argue in many respects we're seeing deflation. People don't notice it because the dollar is inflating, and so prices are getting more expensive in dollar terms. But take an ounce of gold and measure anything that you can in ounces of gold. Go back as far as you want. From 1971 on, go back and measure it in ounces of gold, and you'll find prices are actually going down. Let me show you this way. I'm going to ask, let's see, what was the average house price, should we do 20 years ago? Let's try 20 years ago, in 2005. I can write this down too. Okay, Average house price in 2005, it says the median price was 232, the average was 297. Let's take 297, take the higher price. All right. And what is the average price in 2025? In 2025, we have 534,100. So your real estate has gone up in value, right? And that's good, right? But let's measure it in gold, because in dollar terms, that same house has gone up $240,000, right? Almost 50% gain in 20 years. Not bad, right? So let's look at what was the average price of gold in 2005. What do we get? $449.99. Let's call it $445. $444.99. Let's call it $445. All right. So in 2005, 297,000 divided by 445 would have cost you 667 ounces of gold to buy that house 20 years ago. It's gone up 50% in dollar terms, but how about if we measure the price of gold today against the price of that house? Gold right now is up day $70, $4,031. So we take the average price of 534,100 divided by 4,031, and you get 132 ounces where it took you 667 ounces 20 years ago. Do you see what I'm saying? In terms of the price of anything measured in ounces of gold, you can now buy 5 houses, almost 4 to 5, and that's an asset. Everyone says, well, it doesn't pay any interest. Well, who cares? That's what it's done forever. You go back to 1900, and I can give you examples that show the same thing. Retains its purchasing power. A $20 gold piece in 1900 was 1 ounce of gold, basically, just under 0.9675. And $20, which was the face value, would have bought you a suit, a tie, shoes, overcoat, everything. And that's about what it would have cost you, the whole 9 yards, looking like a stud. Today, $20 won't even buy you shoelaces and a tie. Won't even buy you a tie, not even close. But yet that ounce of gold will still, that $4,000 will buy you one hell of a nice outfit. My point is that gold doesn't pay interest, but what it does is it measures the value or the lack of value of the currency. And the problem is, and there's the problem is people are focusing too much on the relationship between other crap currencies. Yeah, sure, the dollar, as many will say, is the cleanest shirt in the dirty laundry hamper. Measure it against gold, and it's being destroyed. And measure prices in gold ounces, and prices are falling. We are in the midst of a deflationary cycle. We just don't realize it because the currency by which we measure it against is being eviscerated in terms of its purchasing power. My father graduated college in 1963, married my mom. They're still married today. And he said to me, when I graduated college, my first job out of college was at a place called Helene Curtis. It was like a women's cosmetic thing. He was paid $6,000 a year. He said we lived comfortably on that in an apartment, just the two of us. I'm thinking, how is that possible? If you Google what was the average salary in 1963, it's like $9,000 or $10,000. So first job out of college, okay, I believe that. And he could live comfortably on $500 a month. So you ask yourself, is it the prices that we're looking at, or is it what we are valuing it in, measuring it in, that is the real issue? And to me, that is the real.
The divide between those who have wealth and those who don't has widened dramatically. Over half of Americans read below a middle school level, and millions have limited access to higher education. The rise of artificial intelligence threatens to eliminate up to 50% of entry-level jobs within years. Meanwhile, critical industries, from pharmaceuticals to microchips, are outsourced overseas. Savings held in dollars now lose value every year due to inflation. Moving forward, the U.S. must rebuild manufacturing or risk losing both prosperity and national security. The future depends on whether economic restoration begins soon or not at all.
I think that, again, and I like Keith very much. He's a smart guy, and in the industry, he's one of my friends. And I think there are very few people who are as qualified to answer these kind of questions as Keith, not only as the CEO of First Majestic and board member of many other projects, serially successful at that, but he also now, as you mentioned, runs the First Majestic Mint. Yes, a business over the last few months has been parabolically higher than it had been any time since the pandemic. As Rick Rule would say, always, again, using Rick's comments, which I've copied, I've been friends with him for 25 years, is that from the average allotment or allocation of gold and gold-related equities from Joe and Jane Sixpack to the Harvard Endowment Fund is less than 0.5%. Now, the interesting thing is that the Harvard Endowment Fund just spent, I don't know, between 1 and 200 million on gold recently. Things are changing, but it's at that level that we're seeing the majority of purchases. During the silver squeeze, everyone and their sister and brother was calling us, and we were doing, 1,500 orders a day. Now it's a fraction of that, maybe 500, but much bigger in scope. You have people who are scared that the realization that things not only are messed up politically, geopolitically, morally, socially, even take your pick, go down the line, but that the dollar's in trouble. We can't even agree to keep the government open through things that, I'm not going to talk politics here. I have strong views on it, but it usually ends up being too polarizing. So we'll just simply say we're at a place where people who have worked all their lives to obtain money realize that it's easier to make it than it is to keep it. And so we've seen a big rush into metals lately, but that's still, look at what I said at the beginning, record allocation to the equity market by the public, record speculation through options and leverage through margin, all-time highs across the board. And at the same time, this month alone, we've already seen almost 59,000 gold contracts. 59,000. So it's 58,639 as yesterday times 100, 5,863,900 ounces of gold have already been delivered on COMEX this month. Every single month we're seeing this kind of volume. That's never happened before. No one ever stood for delivery, ever. Less than 1% of contracts always stood for delivery on COMEX my whole career. And I've been screaming as loud as I could since 2020, since I got on YouTube, saying things were changing, that we have been seeing the constant offtake of metal through family offices and hedge funds under the title that came out of nowhere in 2020 called the Others. This is the Commitment of Traders report that is published by the Commodity Exchange. It was usually just two-sided, the commercials, which are commercial banks, and the specs, the hedge funds. And they were zero-sum game. It would show the positioning, it shows the positioning of the biggest traders. Then out of nowhere, this third group of reportables pops up. They call it the Others. I expect this as hedge funds and family offices. They start taking huge deliveries off the exchange. Central banks have been doing it since 2017, but they have friends and wear different hats. And these are hedge funds, family offices, and sovereign wealth funds. And then you're seeing the same thing with the central banks. But you're seeing, never saw it here in the US. We've been net exporters of gold forever until November, when Trump won the election. We've become, if not the largest importer of gold in the world, all of a sudden. Who's doing it? Why is no one talking about it? Why are we seeing billions and billions and billions and billions and billions of gold and silver come into the COMEX? Some stays, some leaves in the COMEX. Could stay in there, can leave. I don't know. Who's taking it? Why aren't we hearing about it? Why is there no mention of this on the media? I talk about it every day, but at that level, it's the people far above you and I and everyone else in this room who are the ones that have been buying it. The institutional traders, the sovereign wealth funds, the central banks. But to see it happening at this level, where you get the chief investment officer of Morgan Stanley now saying, instead of it being a 60-40 split between stocks and bonds, as Wall Street has used for 50 years, that was the typical portfolio. And in an interest rate environment that's going straight down since 1982, that would have done well. 60 stock, 40 bond. Now he says, no, 60, 20, 20. Sell half your bonds, put half in gold. Michael Hartnett, the chief analyst for Bank of America, no, he says 25 stock, 25 bond, 25 short-term treasury, 25 gold. You got Jeffries, a former U.S. Mint authorized partner who I worked with for years, and they nominated us to be a authorized reseller. They were one of the primary distributors for all the mints. They know gold better than anyone, although they're not in that market anymore. Next stop for gold, they say 6,600. You got Jamie Dimon talking about it. You have Goldman Sachs talking. Everyone's talking about it at the ultra high level. Those people have been doing it, but the public, no, they're still anesthetized. But like I said, if it's 0.5% and it goes to 2%, well, that's a fourfold increase in demand, and guys like Keith would notice it. And it is getting busier. I notice it, but we're yet anywhere near, I think, that level where the public has woken up to the fact that the road to retirement is not always just paved with stocks and bonds and mutual funds. Quite to the contrary, we are entering a period of time where even the best laid plans need to be reevaluated.
Dollar prices may rise, but gold exposes the truth. Over decades, an ounce of gold has held buying power while the dollar's value steadily deteriorated. For example, despite U.S. home prices doubling in 20 years, a house measured in gold actually became cheaper, falling from hundreds of ounces to around 100. This suggests deflation in real terms masked by currency debasement. More investors and even institutions are turning to precious metals as protection. Gold's role isn't yield, it's preservation. It reveals the hidden decline of fiat money and provides a stable anchor in turbulent times.
It's the same thing I'm talking about on steroids. The only thing I would caution is that, you could look at the mining shares as the sponges floating on the surface of the bathtub. You pull the plug, they'll all fall, including the mining shares. But I do think from a standpoint of undervaluation, as gold and silver have risen to these levels, the mining shares until just recently hadn't cooperated. And so, yeah, you have mining companies right now that have a lower cost of production than the price is at. They're flush with cash. And I think it's a tremendous place to put your money. But I think that I look at it as a pyramid, where the base of your pyramid would be things like paid for real estate and physical metals and assets. The middle portion would be something like 60-day treasuries or utility stocks throwing off a yield, a dividend with a little more risk, but still relatively conservative. And then the pyramid, the top of the pyramid, 10, 15%, would be mining shares and cryptos. And the theory is you lose every penny that you put into it on the top 15. You don't make nothing on the middle 20 or 30. As long as the base of your pyramid is moving at a couple, 2, 3, 4%, you're in good shape. Well, gold has averaged 9.9% per year since 2000. So you're doing well. In other words, to me, you don't invert your pyramid to speculation. But if things go well, you'll make more money on the top 10% than you would on the bottom 90. So it's a Swiss-based formula they've used for 300 years. It's just mitigating risk and making sure that you never invert your pyramid to speculation. In other words, you don't gamble with your retirement and your future. There is a piece of your portfolio that you can, but to gamble with the majority of it is lunacy, and that's kind of what I'm getting at. But the potential and the leverage is unbelievable. There's, again, this is just a generalization, but there's probably more market cap in Coca-Cola than there is in every mining share on the planet combined. So, there's plenty of room to see growth in the mining share industry.
There is a quiet accumulation of gold happening at the highest levels. Central banks, sovereign wealth funds, and major Wall Street firms are buying physical metal and taking delivery. Analysts at big banks now recommend gold as a core portfolio asset, not an alternative. Mining shares remain undervalued, offering opportunity with higher risk. The philosophy is simple. Build your financial pyramid on real assets, not speculation. If change is coming, and many indicators say it is, those prepared with tangible wealth may transition into the next monetary era stronger than ever. The shift has already begun.